After 5 long years in regulatory exile, crypto exchange-traded notes, or ETNs, are back in the UK. That's right, for the first time since 2020, everyday investors can once again get exposure to Bitcoin and Ethereum on the London Stock Exchange through regulated products. But why now? Why did the FCA, which once called these products ill-suited for retail consumers, suddenly change its mind? Is this about investor protection? Or about keeping the City of London competitive in a world that's rapidly embracing digital assets? To understand what's changed, we need to rewind to January 2020. That's when the Financial Conduct Authority, the FCA, banned the sale of crypto derivatives and exchange-traded notes to retail investors. The regulator argued these products were, quote, ill-suited for retail consumers who cannot reliably assess the risks of these assets. In other words, they thought people didn't really know what they were buying. The decision was controversial, but also unsurprising. At the time, crypto markets were volatile, scams were common, and even institutional investors were struggling to price these assets accurately. The move effectively shut UK retail investors out of a fast-growing corner of the global market. Meanwhile, investors elsewhere, in Europe, the US, and Canada, could trade Bitcoin-linked products freely. By 2024, the UK had gone from a leader in fintech to a laggard in crypto access. So what exactly is a crypto ETN? An ETN, exchange-traded note, looks a lot like an ETF on your broker's platform. But there's a crucial legal difference. An ETF typically holds the underlying assets, shares, bonds, or commodities inside a fund. An ETN is a debt instrument, a senior debt note issued by a financial institution that promises to pay the return of an index or asset minus fees. In short, with an ETF you own part of the assets, with an ETN you own a promise. ETNs are not new. They've been around for years as a way to give investors exposure to niche markets and hard-to-access assets. Banks and issuers created ETNs to let people trade currencies, commodities, and exotic strategies on exchanges without the issuer having to hold every single underlying instrument directly. Barclays and other financial institutions were involved in early ETP innovation, and the format has evolved steadily since the mid-2000s. Think of ETNs as an offspring of the broader structured product world of the ETF revolution. Because ETNs are unsecured debt, buying one exposes you not only to the market risk of the underlying asset, Bitcoin say, but also to issuer risk. If the issuer gets into financial trouble, holders of the note are creditors, not owners, and could suffer losses even if the underlying asset rises. That dual exposure, market plus credit risk, is the structural core of any ETN. The London Stock Exchange itself describes crypto ETNs as debt securities that provide exposure to an underlying crypto asset, traded and settled like other exchange-listed products. That structural risk is why regulators were wary of selling these products to ordinary investors in the first place. In 2020, the FCA judged certain crypto products ill-suited to retail consumers because of the extreme volatility, potential for market manipulation, and limited investor understanding. Concerns that fed the earlier prohibition on retail distribution of some crypto-linked ETNs. The language used across regulatory summaries and legal commentaries highlights those exact worries about retail investor protection. All of that, the structure, the history, and the regulatory caution is what makes FCA's 2025 reversal so interesting. If ETNs are debt instruments with legacy use cases, why is the regulator reopening access now? That's what we'll look at next. Fast forward to 2024. And after years of silence, the FCA makes a quiet but dramatic shift. In March, the London Stock Exchange announced it would begin accepting applications for crypto ETNs with FCA approval, but only for professional investors. In other words, the door wasn't wide open yet, just cracked slightly. The FCA said the crypto market had matured enough to allow institutional access, where professional investors understand the risks and have the systems to manage them. But retail investors were still locked out. The FCA reaffirmed that, quote, crypto asset ETNs remain inappropriate for retail consumers due to the inherent risks in these products. Then, in October 2025, everything changed again. The FCA announced it would open access to crypto ETNs for retail investors, reversing 5 years of policy and marking a major milestone in the UK's approach to digital asset regulation. Suddenly, the products once labelled too dangerous for consumers were being welcomed back to the London Stock Exchange. So, what changed? Market maturity, institutional demand, political pressure. For one, the FCA says the market has matured, in that there is now increased trading history and data. They're not wrong. We now have regulated custodians, improved market infrastructure, and clearer valuation methods. The Bitcoin ETFs in the US, approved earlier this year, have shown that institutional grade products can work safely under the right supervision. But there's also momentum and competitive pressure. Industry voices in the UK, including investment managers and crypto custodians, have warned that the city risked falling behind as other financial centres embrace digital assets. So while the FCA still warns that crypto is high risk, its stance now acknowledges a simple truth: crypto isn't going away. And by bringing it under regulation, the UK can offer investors a safer path to participate, and perhaps help keep London competitive in the process. But how much demand is actually out there? How many people in the UK really own crypto? And what does that tell us about the FCA's decision? But this wasn't just a top-down decision. The FCA's own research shows that public appetite for crypto has exploded. According to its 2024 Consumer Research Report, 12% of adults now own crypto assets. That's roughly 7 million people. And among those who don't own any crypto, 26% said they'd be more likely to own it in a market that's regulated. Additionally, 25% say that more regulation would make them more likely to invest in crypto assets, but only if this regulation included some financial protection in the event of losses. That tells you a lot about where public confidence sits. The FCA has spent years warning people about crypto's risks, but their own data now suggests the ban may have simply driven retail investors to unregulated overseas exchanges. So perhaps from their point of view, it's better to bring crypto trading back under the regulatory umbrella rather than pretending it doesn't exist. And you can see the logic. If people are going to buy crypto anyway, isn't it safer to let them do it on the London Stock Exchange through a regulated product? So what exactly is being launched? So far, several major issuers, including WisdomTree, 21 Shares, and VanEck, have listed Bitcoin and Ethereum ETNs on the LSE. These ETNs are physically backed, meaning issuers hold real Bitcoin or Ethereum in custody, often with regulated custodians like Coinbase or Zodia custody. But remember, these are still debt instruments. You're not buying the Bitcoin itself. You're buying a note that promises the return of Bitcoin's price minus fees. Fees typically sit between 0.95% and 1.5% depending on the issuer. Trading will likely be available through major investment platforms, though some brokers may continue to limit access until their risk controls are in place. And to be clear, the FCA's tone hasn't softened. They continue to describe crypto assets as high-risk investments, warning that consumers should be prepared to lose all their money. This isn't an endorsement of crypto. It's a recognition of reality. People want exposure, the infrastructure exists, and now regulation is catching up. Of course, regulation doesn't make volatility disappear. Bitcoin can drop 20% in a week. Ethereum's price swings can be just as violent. And ETNs carry additional risks, such as counterparty failure. If the issuer goes bust, investors could be left with nothing. These are, after all, synthetic products. If you don't have direct ownership of the crypto, just a promise, if that promise breaks, there's no blockchain to back you up. So the key question is, are we opening access or reopening old wounds? We've seen this before with complex derivatives before 2008, with leverage ETFs, with mini bonds. Every time the industry says, it's safer now. Sometimes they're right, sometimes they're not. So what does this mean for you and me, ordinary retail investors? In theory, it means easier, safer access to crypto exposure without the headaches of private keys, wallets, or exchange hacks. In practice, it still means risk. These ETNs might make crypto feel like traditional investment, but underneath it's the same volatile market. If you're tempted, make sure you understand you're buying a debt instrument, not Bitcoin itself. There's no FSCS protection, and price swings can be brutal. So don't mistake availability for safety. The FCA has changed its stance, but the warning remains the same. Do not invest unless you're prepared to lose everything. Zooming out, this move may signal something bigger, a more open, pragmatic stance on innovation in UK finance. After years of caution, regulators appear ready to experiment, to balance protection with participation. And as London competes with New York, Zurich, and Singapore for fintech dominance, that balance might define the next decade of British finance. Crypto ETNs won't change the world overnight. They might mark the start of a new phase, one where regulation and innovation can learn to coexist. So after 5 years, crypto ETNs are back. Not because the risks have vanished, but because pretending they didn't exist no longer made sense. Whether this is a victory for investors or a warning shot for regulators depends on what happens next. But one thing's for sure, the FCA's reversal tells us something about the future. The world of investing is changing fast, and the rules are racing to keep up. If you found this breakdown useful, hit like and subscribe. Tell me in the comments, are crypto ETNs a smart way to invest? or just the next big risk wrapped in a shiny new package?